If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, it's Tortoise Investing coming at you today with 5 dividend stocks you can buy and hold forever. We got some powerhouses for you today. If you're new, hit that subscribe button, hit that little red button for me. I'd greatly appreciate it. It is super free and easy to do. And like the video, drop a comment down below. Let me know what you've been buying, what you've been looking at, if you're holding cash. I'd love to hear from you. And all those things makes the YouTube algorithm super happy. Help me march toward 1,000 subscribers. I greatly appreciate it. Now, none of this is financial advice. As always, do your own research and stuff before buying anything. And before we dive into everything, let's go ahead and take a look at the portfolio. This is how we're looking right now. We have got some things in the red here, but I am just going to buy these as I am getting paid. That is what I do. If I'm in the red, that's perfectly fine. I'm just going to DCA down because I am a believer long-term in all of these holdings. Now, if we take a look here, the portfolio year to date, we are up 16.35%. The S&P 500, let me refresh this, is up 12.18%. So we are still beating the S&P by a couple percentage points. I want to still just extend that lead, and that's what I want to do. That's my main mission, is to have a market-beating portfolio that's got a good, decent yield, and I get to be able to drip those back in and just grow over time. But yeah, without further ado, the companies we're going to be taking a look at, we got ASML Holding, we got Lockheed Martin, MasterCard, love me some MasterCard, Home Depot, and Apple. All right, ASML adjusted free cash flow yield of 2.49%, got a dividend yield of 1.31%, and a payout ratio of 22.6%. If we take a look here at the 5-year chart, back in 2021, this thing was setting at $887 a share, now down to $573. Even here as of late, this thing was at $757, so it's down over $100 and then some. So again, do your own research and stuff, but I like what I'm seeing with this company. Revenue's been increasing at a rate of 16% over the last 10 years. Very nice. The free cash flow has been increasing at a rate of 30%. That is bonkers. Absolutely crazy. Let's look at the shares adjusted here. Yep, stock compensation is not an issue whatsoever. EPS been increasing at a rate of 18% over the last 10 years. Very nice. The dividend's been increasing at a rate of 8.71%. The reason this is so wonky is because of the currency conversion that has to go on, because this is paid in a different currency and that's converted over to U.S. currency. And that's the reason that the dividend's kind of all over the place, but still yet a great company that's growing so quickly. They have more cash than debt on hand, which is something you always love to see, especially if interest rates being the way they are right now. They ain't got to worry about anything. They got to do some share buybacks or something. They got you. They can just do it with the cash they got on hand. The shares outstanding, speaking of share buybacks, over the last year, 3%. Very nice. Look at that. That's over 12 million shares bought back between 2021 and 2022. Very, very nice. And the return on capital employed is mid to upper 30s. So we got 37% in 2021, 34 right at 35% in 2022. Very, very nice. They're using their allocation to buy back shares. Love it. Love it. Next up, Lockheed Martin is another one that I've had my eye on for a minute. It keeps dropping, and I just keep eyeballing it. I really, really like this company a lot, and especially right now. It has just dropped so much. Adjusted free cash flow yield of 5.57%. That is awesome. Dividend yield 2.87%, and payout ratio of 43%. Now, let's take a look here. It's off its recent high in April of $501 down to $408. This thing's down almost $100. I'm digging it. Revenue's been increasing at a rate of 5.27% over the last 5 years. This company is winning government contracts like there is no tomorrow. This is the government's go-to for their missiles and all their military needs. They love them some Lockheed Martin. Free cash flow has been increasing at a rate of 25.77% over the last 5 years. This is just amazing as well. EPS has been increasing at a rate right at 10% over the last 10 years. Accelerated 25% over the last 5 years. Very nice. Now their debt, they have $15.4 billion in debt. Their EBITDA is $8.7 billion. That's not an issue to me. Personally, when I'm looking at companies and comparing their debt to EBITDA, I don't like them to have more than 3 times their EBITDA in debt. So this being, 15, this is 8. It's not even 2 times. That's green check mark for me. It's not an issue. Dividend's been increasing at a rate of 10% over the last 10 years. This is just a set of stairs. This is compounding like crazy, and I love it. Shares outstanding. This is another thing. I love it. I can't get enough of this. Over the last 10 years, 2% buying back shares, right at 2% over the last 5 years. And they've accelerated here lately over the last 2 years, 3% compounding at their buying back their shares, and the 4.6% in the last year. So take a look here. 2020, they're setting at 281 million shares, and they have bought that down to 264. So they are just buying back more and more shares, and I love that. Return on capital employed has been in the mid to lower 20s since 2018, which is very high and very nice. I really like this company. Next up, MasterCard, another just behemoth powerhouse, and I'm going to show you something with this one. Adjusted free cash flow yield of 2.66%. It's got a lower dividend yield, but this thing is growing its dividend a lot very quickly. 0.57%, payout ratio 20.5%. You might be thinking, this thing's ran up. Look at that. It's almost at its all-time highs. Well, if you take a look here at the 5-year chart, this thing's been bouncing around this 400 zone for a hot minute. It went up and touched it back in April 2021. It got up close to it in July 2021. Went back up, touched it around January 2022, and then it touched it again May this year, and then actually broke above the 400 mark. So this is a company that's been wanting to break out for a while, and between these areas, yeah, of course you want to always buy at the bottom, but it's a great company. I love what they're doing. This company, they're almost in everyone's wallet. This and Visa. I just like MasterCard just a little bit more, but it's still not at a bad price. I don't believe, again, personal opinion, do your own research and stuff before just diving anything, but I was just wanting to show you, this thing's been bouncing around this 400 zone for a hot minute, and it's below 400 now. Revenue's been growing at a rate of 11.64% over the last 10 years. The free cash flow, 13.9%, right at 14% over the last 10 years. EPS growing at a rate of 16.6% over the last 10 years. This is just up and to the right, up and to the right, up and to the right. Debt, they have $13.75 billion. Their EBITDA is 13.39, so almost matches. They could pretty much just pay off their debt now if they wanted to. Now the dividend, 25.25% growth rate over the last 10 years. Over the last 5 years, right at 18%. This is great. This is why the yield is low, because they're able to grow their dividend at a rate of 15 to 20% every year. That is amazing, and I love it. This is compounding. This is a strong compounder. This is compounding 101, what you want to see. Shares outstanding is another thing. They get a lot of capital in, and it's MasterCard. Their moat's already as wide as the rivers and then the oceans and the seas. They buy back shares over the last 10 years, 2.56%. Over the last year, over 2%. Just buying back shares. They're using that capital for you, so you can, get a bigger and bigger piece of the pie. The return on capital employed is another thing I can't stress enough of this company. It's so good. 2020 and 37%. 2021 is 41%. 2022 is right at 50% return on capital employed. You could cut this in half twice and it'd still be great. It's awesome. Next up, Home Depot. I personally like Home Depot a little bit more than Lowe's. I mean, they're both great, but I just like this one a little bit more. So Home Depot adjusted free cash flow yield of 5.23%, dividend yield 2.73%, payout ratio 51%. All check marks for me. They're off their recent high of, let's see here, back in February. It looks like they cracked up to 340. So it's down a little over 10% off of its recent highs. Take a look at this 5-year chart now. Back in 2021, this thing set at $415 a share. So again, similar to MasterCard, it's not been able to break out. It's kind of been hovering around this, 270 to 330 range for around a year plus. Might be a great company to add into or buy. Take a look at them. Take a look at these. Again, not telling you what to buy or sell. I'm not guaranteeing any returns, but these are great companies, in my personal opinion. Revenue's been increasing. I raised 7.73% over the last 10 years. Very nice. Just up and to the right. The free cash flow has been increasing. I raised 7.34% over the last 10 years. Has been decreasing since 2021, though, as you see here. It's a little downward trend. Let's see here. I'm going to look at the quarterly for that cash because they're setting 11, 3, 4, 5. So, yeah, they're still ticking in the right direction. This is growing. This year. We're supposed to be having some issues right now, but free cash flow is growing for them. So yeah, that's a great sign. EPS been growing at a rate of 18.72% over the last 10 years. This is just straight up very nice. See it again. Debt, $41 billion in debt. Their EBITDA is $37 billion. Again, this is not that big of an issue to me because the debt's not more than 2 times the EBITDA. This would have to be over $54 billion to be the case. I think that's the reason why I like Home Depot more than Lowe's. I think their debt ratio is a lot better. Dividend's been increasing at 18.28% over the last 10 years. Very, very nice. Very nice. Again, just stair steps. It's a big step right there, but still steps nonetheless. And shares outstanding decreasing at a rate of 3.81% over the last 10 years. Just right down we go. It's what you love to see. Again, so you're getting a bigger and bigger piece of the pie. Let's see here, just for correlation. Back in 2020, they had 1.1 billion shares. Right now, they're at 1.03 billion. So they are chopping away at it, and I like to see that a lot. Return on capital employed, 2021, they were at 38%, 2022, 53%, 2023, 45%. This thing's been hovering above 30 since 2014. Return on capital employed above 30 is just crazy in my eyes. It's so good. Again, Home Depot and Lowe's, similar situation as MasterCard, LMT, all of these really moats. These are moats. These are your go-tos for your home improvement stores. I like it, especially around these prices. This keeps dropping. I'm gonna keep eyeballing it super hard. Next up is Apple. I love me some Apple. I hold Apple personally. It's got adjusted free cash flow yield 3.34%, dividend yield 0.55%. Again, you might be thinking, oh, it's low. It's a low dividend yield. What are you talking about? And they don't increase their dividend all that quick. They do share buybacks like crazy. I'd rather a company do share buybacks than pay a dividend. That's just me. I want a bigger and bigger piece of the pie, more and more piece of that business. Payout ratio is 15.58%. Not an issue. It's Apple. They control the world pretty much. Let's take a look here at the 5-year chart. So they hit around this price back in 2022. They hit around this price the end of 2021. They hit again the price August 2022. They cracked up almost at 200. They wanted to back in July, and it is going back down. I think it's over $20 a share. So this thing's down. What was that, about 15 or so percent off its recent high? I'm just gobbling it up. As it's dropping down, if it's below my average buy price, I'm just adding more and more each paycheck. DCA for life. All right, revenue's been increasing around 9.68% over the last 10 years. It's Apple. Again, just their services has been increasing so heavily. They're integrating all their stuff into the Apple space, and they're just killing it. They're killing it. Free cash flow has been increasing at a rate of 10% over the last 10 years, 17% in the last 5. This is just bonkers. And stock-based compensation, not an issue whatsoever. EPS, 14.48% over the last 10 years. That's just It's nuts. I can't brag enough about just how crazy this company is. Debt, they have $98.9 billion in debt. Their EBITDA is $130 billion. They could just pay this off, not care, not miss an ounce of sleep over it. Now, the dividend, they don't increase it super quickly. Over the last 10 years, a rate of 8.22%, and over the last 5 years, 5.6%. Their last dividend hike was like, 4.35%. And again, you might be thinking, oh, that's not that much, what are they doing? They're buying back shares, my kind sir or madam. Over the last 10 years, 4.72%. Over the last 5 years, 4.92%. This is just crazy. Crazy. They have bought back about 1.5 billion shares. 1.5 billion shares bought back since 2022. Just let that number sink in for a second. Billion is still just going down. They're still buying back shares every quarter, it looks like, too. That's nuts. It's so good. Return on capital employed, it's been around 30% forever and a day. And 2021, it was 48%. In 2022, it's 60%. Again, just more green check marks for old Apple. But yeah, 5 dividend stocks that you can buy and hold forever. Again, do your own research and stuff before buying anything. Make sure you hit that like and subscribe button for more. And until next time, see you.